So, Hannah, thank you so much for joining me here today at PPIF. Tell me about how the macro environment is impacting deal appetite, risk tolerance in the US infrastructure landscape.
Yeah, look, I think deal appetite is strong, that the underwriting discipline remains high. So a lot of investors are prioritizing downside protection and not as much leverage potentially as they have historically to ensure that there is robust investment thesis around the investments that they're making. But whilst M&A activity last year was a little bit slower, our expectation is that 2026 is going to be really robust and hopefully very fruitful for DC.
Yes, that's exactly what I'm hearing from many other companies that have been talking to me, actually.
Yeah.
So tell me about the geopolitical uncertainties that are kind of marking the landscape here. How does that impact investment appetite, and especially for people that are keen to grow cross-border?
Sure. I think the reality is that uncertainty is certain. So if you are based in the US, you recognize that with a change in administration, there is always going to be noise, perhaps slightly more with this administration than others. But the investment appetite within the US is strong. Now that there is quieting down of tariffs and the impact of that, that's why we believe that there will be more opportunity. We don't need to know all of the answers, but stability is important. And so when there is noise around the potential implications, such as tariffs, it does slow down opportunities. But with that laying to rest now and there being more certainty, we are hopeful that 2026 is going to see more M&A opportunity, and with that will drive also financing opportunities.
Amazing. So I maybe just wanted to touch upon data centers. I
Sure.
mean, everybody is talking about data centers driven by AI and the need to kind of grow that. So how is that impacting underwriting power ability and just the regulatory risk that comes with it?
Yeah, look, there is, we were just on a panel and everyone was talking about the fact that data centers is obviously a key trend. AI is driving that, and the investment opportunity is within the trillions. But the key thing behind data center growth and digital growth is power. And actually, power availability is a key credit fundamental when we're looking at these opportunities. It's not just about who is the tenant, it's about are they going to get the right power. And so thinking about behind the grid opportunities and how they are powering these data centers is going to be very important and really will dictate who are the winners and losers. Transmission is an issue within the US, and investment does need to be made there. But before that is fixed, this behind the meter opportunity, whether that's with combined cycle gas turbines or offshoots of existing gas pipelines, is going to be incredibly important.
Interesting. And finally, maybe just let's talk about capital deployment. So with infrastructure debt markets opening and base rates easing, how does that impact the timing of capital deployment?
Again, rates were higher over the last few years, and I think there was initially sentiment that people would wait until the rates reduced. And then there was realization that actually they were probably going to stay high for a reasonable period of time. And many issuers and companies needed to refinance. Ultimately, debt is still cheaper than equity. With interest rates easing, it becomes less of a view about timing. I think there is still a preference towards shorter dated tenors and not locking in these higher rates. Even though rates are coming down, they are still at elevated levels compared to the last 5 years. And so having a preference towards slightly shorter dated transactions and allowing flexibility for refinancings remains important. But again, from our standpoint at DC, we are incredibly busy on the refinancing side and capital raising standpoint. So it's less about timing and it's more about access to liquidity and the right type of structure, providing that flexibility for our clients.
And that's also ties into all sorts of risk management, underwriting, etc.
Correct. Yes, exactly. So private placement investors interestingly, there was a trend 5 years ago for it being long. You know, they wanted 10, 15-year paper. All the conversations that we've had this week, they do still want that medium, longer dated paper, but they are willing to go as short as 5 years, and now also floating rate, which is an improvement and allows them to continue to get access to these transactions, even if issuers don't want to go quite as long.
Amazing. Thank you so much.
Of course, thank you.